China's economy grew at 6.6% in 2018, down from 6.8% year on year. That marks the slowest annual rate since 1990. So where next for China's equity markets and the yuan and the economy? Nick Parsons is the head of research and strategy at ThomasLloyd. Nick, thanks so much for coming in. So what did you make of the numbers?
I thought they were a mixed bag overall. You're certainly correct in pointing out that it's the slowest for 28 years. And it does certainly sound dramatic when you just take that headline in isolation. But I think I'd make 2 points. The first is that it was in line with expectations, so there were no negative surprises there. And secondly, 6.6% growth for an economy the size of China is still remarkably good. Because what we have to focus on is the amount of GDP, the amount of extra output and production that has created. So let's focus not just on the rate of growth, which yes has slowed to a multi-year low, but let's look at what it actually means in terms of the increase in production and the increase in output.
So we know there's a lot of scepticism from the international community when it comes to the official data coming out of China and the government there. What do you think the real growth rate is? What's the actual figure that perhaps they're not being completely transparent about?
Well, I think you can estimate China's GDP by taking partial indicators such as railroad freight and electricity usage and steel output and these so-called intermediate indicators. And then we probably look at a number somewhere between 5 and 6. I think the scepticism over Chinese numbers is probably justified, but equally, let's remember that they are going to be officially sanctioned. That's to say, these numbers would not have been released, not have been published in current form, unless someone very high up in government was okay with their release. So the fact that they do show growth continuing to slow down is a message that the government is actually happy to go along with. It doesn't mean it's happy at the message itself, but it's got no problems with having that slowdown message in the public domain. And I think that is also quite important. It shows us that the government is being more realistic, it is being a little bit more open. We've no means got full transparency on the data, but I think it's a helpful sign that they do release numbers which, at least at first glance, seem to be consistent and credible, if not precisely accurate.
So it seems as though China is slightly concerned about these slowing growth figures, and that's why we've seen a number of stimulus measures, both on the fiscal and the monetary side in recent months. Do you think those are working, and what might we expect in terms of further stimulus moving forward? I
think the measures are beginning to work, but of course this takes time. China is now such a large economy that you can't turn it around on a sixpence, as it were. It does take time for these to take effect. And as well as the GDP numbers that we had earlier this morning, we also had industrial production and we also had retail sales. And they were actually, for choice, slightly at the better end of expectations. So there is some glimmer of hope there. Yes, we've still got problems with bad debts across wide swathes of Chinese industry. Yes, we still have issues around consumer confidence relating to the fall in equity prices, because 2018 was a terrible year for Chinese equities. But there are, I think, still some first signs that perhaps we might be stabilising at or around this lower level of growth. And I think there's some scope for encouragement. That's way from saying we're going to get back to the double-digit growth that we saw in 2010 or 2012. But I think there are some signs of encouragement that we could stabilise at or around current levels. At least I think we could be comfortable with putting a 6 in front of GDP forecasts for 2019.
All right, now you mentioned the equity market there and pointed to the fact that, of course, 2018 was a very torrid year for equity prices. Let's take a look at the China 300 here. This is the Shanghai Composite, as you might know it. Clearly a very negative pattern on the chart here. Do you think we're past the trough, and do you think that there could be upside for the Chinese equity market in 2019?
I think fortunes and reputations have been lost by calling the bottom in the Chinese equity market. What I would say, though, is that the EM equity universe as a whole has had a very positive start to 2019. China has lagged somewhat in that move, but we're already looking at seeing markets which are up between 3 and 4% worldwide in the EM universe, and that has got to be of some help. And I think the fact that the currency has also been allowed to strengthen, let's put it that way, is also a positive, because it helps us to avoid that vicious spiral where currency weakness begets equity market weakness, which in turn weighs on the currency. And I think that we're seeing some stability around 675, 680 in the renminbi. Now, as long as that persists, that will lead investors towards the conclusion that the authorities are comfortable and not seeking to ramp up pressure on trade talks through the exchange rate. And as long as that stability persists, then I think we could be a little more confident in seeing this EM and Chinese equity rally continue. For me, as ever, all the clues are going to be in the currency.
So what is your outlook for the yuan this year then? Well,
I think we're going to stay below 7. If we were to print at 7, and remind all our viewers here that the all-time high is around 698, 699. So as long as we don't print 7, and I don't think we will, then I think the outlook for equity markets is good. There's a little bit of there's a feedback loop here, if I could call it that. The Chinese authorities are moving the fixing of the exchange rate to be more market driven. But of course, they in turn are the biggest market participants through the state-owned banks. So they themselves give signals to which the fixing is then allowed to respond. So it's far from being a true market-determined exchange rate. But it was noticeable when we had that collapse in EM equities in the fourth quarter of last year, and when that Chinese equity sell-off accelerated and deepened. That was at a phase when the exchange rate was being allowed to move up towards 7. Now, once they backed off from that, and then we saw some stability and then a rally in equities, I think that tells us the clues that we have to look for. So as long as we carry on with a 6 print, the big figure is 6 in dollar CNY or dollar CNH. As long as the big figure is 6, then we're probably okay for the EM equity universe. And that gap which developed in the first half of last year between EM and developed market equities can carry on narrowing a little.
All right, now I wanted to get your view on the trade war. Of course, we're in this 90-day ceasefire right now. The 1st of March deadline is looming fast. How do you expect this to play out? Because it seems to me as though there's almost 2 trade wars going on. There's the one relating to tariffs, and then there's the one relating to technology transfers, intellectual property. The former perhaps easier to solve, the latter less so.
Well, I think what's really needed here is statements of intent that are credible and appear to have substance, because you cannot solve the problem of intellectual property, because it's not a solution that has a simple, it's not a problem that has a simple solution. So it's not going to be sorted overnight, but as long as there are credible steps towards an agreement, and I think it's both sides can begin to see that it's in both of their interests to come to such an agreement, because it's not just the Chinese economy that would suffer if we can't get that, but it's also going to be the US, because of course US technology in many cases uses China as its manufacturing hub. You know, the iPhone exists solely because of Chinese manufacturing. All the intellectual property remains in the US. That's where some of the dispute is. But if you took away the Chinese manufacturing, you wouldn't have an iPhone. So I think it's going to, both sides can see that it's in their mutual interest. That is a good starting point. And I think both sides can see that equity markets are extremely sensitive to that. I think that's also helpful. And I'm more confident than not, and that may only be with a 60% confidence rather than 99% confidence, but I'm more confident than not that by March the 1st there will be a signable agreement. There will be some tangible signs of progress to which they can both put signatures.
All right, glass half full there, Nick. Thank you so much for your time. That was Nick Parsons, Head of Research and Strategy at ThomasLloyd. I'm Victoria Scholar. Thank you for watching IGTV, and we'll see you very soon.